Okay, report 2, European and UK munitions manufacturers. BAE, Rheinmetall, MBDA, Leonardo, Saab, Thales. So if you've watched report 1 on the US primes, this is the mirror image, except the mirror is a tad unkind to Europe. So Friar's building the fundamentals layer, Munger's thoughts. The money isn't in scrambling to trade the headline today, it's in having the patience to let a properly formed setup arrive on our terms. So 4 numbers on this slide to consider. 98%. That's the share of Europe's rare earth magnet components that come from China. Compare that with America's 70% dependence on Chinese rare earth imports, as mentioned in Report 1. Europe's number is both higher and narrower. It's concentrated in the actual magnet components, which is about as close to the sharp end of a supply chain as one can get. 6 times. European rare earth prices have already run up 6 times higher since the restrictions began. 8 times. MBDA's order backlog relative to its annual revenue. That's an enormous number, and we'll come back to it. The point of the executive summary is to give the scaffolding for the rest of the report. Europe has worse import exposure and a weaker public sector path than America does, and yet the order books are, frankly, extraordinary. The order books, BAE Systems half-year numbers reported 30th of July are about as clean a beat as we will see in this sector. Order intake £16.4 billion, a record backlog of £84 billion, sales up 9% and a full-year guidance raised on top of that. On the surface, a company firing on all cylinders. But let's look under the headline at the composition, because this is the bit Friar actually finds interesting as an economist. European sales rose 30% in the half, a strong number, and yet Europe is 33% of the group's backlog, but only 13% of its sales. The gap between backlog share and sales share is future revenue that hasn't converted into cash yet. It's the same question we asked of the US primes in Report 1, but proportionally it's a bigger gap here. On the capacity side, notice where the money is actually going. Austin, Texas, Hudson, New Hampshire, Endicott, New York. BAE's capital spending is disproportionately American, even though it's a UK company with a European backlog problem to solve. And I'd flagged the CFO's comment, Brad Greaves, saying the priority is investing internally rather than buying growth through acquisition. We could read that as a hint about how management themselves see current sector valuations. When management would rather build a factory than buy a competitor, they're telling you something about what they think the competitor is actually worth. MBDA order book. MBDA is a joint venture of BAE, Airbus and Leonardo. And this is the slide with the single number Friar keeps coming back to across the whole report. A backlog of 48 billion euros against half-year orders of 6.5 billion. That's a backlog running at roughly 8 times annual revenue. So, let's think about that number is actually telling us. It's not primarily a demand signal. MBDA isn't short of customers. It hasn't been for a while. 8 times revenue is a capacity statement. It's a company that has more work contracted that can plausibly deliver at its current rate of production. The €5 billion investment program through to 2030 for modernising sites, expanding capacity and strengthening supply chains is the direct response to exactly that gap. Now let's read the backlog figures. A big backlog sounds unambiguously bullish, and often the market treats it that way in the short run. But a backlog that's growing faster than the company can build against, it really a statement about execution risk, not about demand risk. Those are very different risks to be priced. These are two separate concepts. Rheinmetall order book. Rheinmetall's Q2 numbers are the strongest in the report on a pure momentum basis. Backlog up from €56 billion a year ago to €80 billion now. Nominations up 28% and an operating margin of 17.1%, the highest the company has ever posted. Management is now guiding a backlog that more than doubles this year to £135 billion, with sales growth of 40 to 45%. The capacity investment is squarely aimed at the propellant bottleneck. Powder production at Nitrochemi in Switzerland and Germany, propellants at Rheinmetall in Spain. That's worth noting because it tells us where the supply chain management think the constraint actually sits. Not in final assembly, but upstream in the chemistry. The working capital point, Rheinmetall took delivery of $6.2 billion in supplies to build stock, and Q1 operating free cash flow was negative £285 million. Chairman Paperger's own words, "We need these goods in our stocks, otherwise it's impossible to grow," is about as honest a statement of the trade-off as you'll ever get from a CEO. Growth is being bought with cash. Okay, the rest of the field's order books. We won't spend much time here because the pattern is consistent. Saab's numbers are genuinely remarkable in their own right. Order bookings up 74% in 2025 to a record $19 billion, with a year-end backlog of $30 billion. Leonardo, Thales, Naval Group, and Navatia are all competing in the same procurement cycle. The reason Friar includes this slide rather than just focusing on the three big names is that it tells us the demand story is broad-based across the whole European defence industrial base, not a quirk of any one company's contract signing calendar. There is a note of caution. Hanwha, the South Korean group, and other low-cost producers are adding real pricing pressure in land systems and munitions specifically. That's a margin risk sitting underneath all these lovely backlog numbers. And it's worth remembering that a full order book doesn't automatically mean a fat margin on every unit inside it. Now, rare earth exposure. It's worse for Europe. 98% of Europe's rare earth magnet components come from China, against about 70% for the US on rare earth imports overall. Both regions sit at around 90% Chinese dependence on rare earth processing and over 90% on magnet manufacturing specifically. So at the very top of the funnel, the exposure is genuinely similar. It's as we move down towards the finished component that Europe's position gets worse. And we'll add to that, China supplies 31% of the EU's tungsten and 97% of its magnesium metal. And EU rare earth demand is forecast to rise sixfold in 2030. That last figure is important. It isn't a static exposure problem. It's one getting structurally larger just as the geopolitical friction around it increases. This isn't hypothetical anymore. The IEA has recorded prices up to 6 times higher. There have been actual production stoppages, first in automotive and now spreading more broadly through dual-use licensing requirements. Antrium oxide and heavy rare earth prices outside China have surged on scarcity and stronger Japanese buying. When I talk about wanting usable facts rather than just headlines, this is what I mean. Munger's line about a framework of theory. A price chart moving is a fact. A price chart moving because of a specific named licensing mechanism that we can watch and calendar is a fact that we can actually use. 4 problems specific to Europe. Firstly, the dated clock. China's second wave of export controls is suspended until 10th of November, just a few months away. So this one is worth note because it's structurally different from everything else we've been talking about in this report. Most of what we've discussed so far is a trend. Prices going up, backlogs growing. A trend is directionally useful, but it doesn't give us a point to act around. A suspended control with a hard expiry date does, and is exactly the kind of thing Paul Tudor-Jones means when he talks about waiting for a trade where you have all the factors in your favour. A dated, falsifiable catalyst is one of those factors. Either the suspension is extended or it isn't, on or around a specific date. That's rare, and it's valuable precisely because it's rare. Next, the commercially fragile substitution route. CareMag, the French-Japanese rare earth recycling venture, is a good initiative, undermined by a bad market. It depends entirely on commercial demand from Europe's car and wind turbine industries, both currently weak, to justify the long-term contracts the investment needs. Compare that with the US, where the Department of Defense simply took a $400 million equity stake in MP Materials and funded Linus's American plant directly. Washington is socializing the risk. Europe is hoping the private sector volunteers. That's a materially worse structural position, and it isn't a small technical point. It goes to whether Europe's mitigation actually arrives at any predictable timetable at all. Third, working capital. We touched on this with Rheinmetall already. £6.2 billion of inventory build, negative £285 million of operating free cash flow in Q1, and the company waiting on advance payments from Romania and Germany under the so-called Arminas contract, which Papperger himself calls the big elephant in the room. No value, no timetable disclosed. Stockpiling against supply risk is entirely rational corporate behaviour. It also means cash is being consumed today against revenue that arrives later. That has a direct implication on how we think about timing. And fourth, no European tactical solid rocket motor base. Europe simply doesn't have a comparable industrial base for tactical SRMs, short-range missiles. Every interceptor program either draws on the same constrained American supply chain or on a handful of legacy European makers with limited capacity. We'll cover the attempted fix. Cambridge's Aerospace's Norfolk facility. We'll do that in Report 2. As the middle of this year, it's still under construction, so we'll treat it as a future data point, not a present one. The honest counter case, because a thesis that can't survive its own strongest objection isn't really a thesis, it's a hope. So here's the balance. The capacity investment is real money aimed at real bottlenecks. Nitrochem's powder lines, Expal's propellant plant, MBDA's €5 billion program. These aren't press release commitments, they're actually funded projects. The backlogs are genuine contracted orders, not soft pipeline that can evaporate at the next budget review. NATO's 5% spending target and the broader push for European strategic autonomy gives this a multi-year demand floor that doesn't depend on any single government's mood at the time. Okay, and this when we're thinking about entries. In March 2026, or coming into the March results, Rheinmetall was up roughly 540% over 3 years, and the gains looked to be moderating, up just 3.4% year to date at that point. The read was on that a lot the fundamental story we've just spent 8 slides building already be reflected in the price. But we'll update to the middle of this month, August 2026 remark. That picture hasn't merely moderated, it has reversed. The trailing 3-year gain is now about 350%, down from 540. And do note the oddity because it's a teaching point in its own right. The figure is lower than it was in March, even though another quarter has gone by. The reason is the drawdown. The shares peaked above €2,000 last September and have since given back something like 40%. Year to date, they're down roughly a quarter. Gains moderating has become gains reversing. And the cause, in late June, Germany moved to scrap the F-126 frigate program, and Rheinmetall lost 19% in a single session. The single government mood risk Friar described a moment ago became concrete within weeks of writing the line. At the August results, the company trimmed full-year sales guidance by €300 million on that cancellation. And first half free cash flow came in at negative €1.6 billion. As a 6 billion inventory build consumed cash. This even as backlog hit a record and nominations ran up nearly 500%. Orders at record highs, cash going out the door. That doesn't dismiss the fundamentals. The backlog is still intact, still growing. What it does is turn the entry question into a rhetorical one. Is anything left after a 540% run? Into a genuinely live one. After a sharp derating on a cancelled contract and a cash flow wobble, is the market now under or overpricing an order book that is, on the company's own numbers, still at record numbers? So the line from Metallonomist at the bottom of the slide is a very useful sentence to consider. The immediate risk isn't total loss of Chinese supply. It's higher compliance risk, licensing uncertainty, and a widening security premium for non-China material. Thus, in plain English, the magnets don't stop. They just get more expensive, slower, and more exposed to paperwork that can be withheld at any time. That's a much more tradable, more precise formulation of the risk than China might cut off rare earths. And precision like that is exactly what turns a pile of facts into Munger's usable lattice work of theory. Okay, finally, watch list. 6 indicators, each with a reason and a rough timing. The China control wave suspension expiring 10th of November 2026 sits at the top, for the reasons I gave earlier. It's the one item on this list with a hard date attached to it rather than a rolling or a policy watch next to it. The rest are the things Friar will be checking in on through for the rest of the year. European rare earth and tritium oxide prices as an ongoing read on the security premium. BAE's backlog to sales conversion at its February 27 results, which will tell us whether that 33 versus 13% gap is closing. Rheinmetall's advanced payments from Romania in Q3, which tells us whether the working capital squeeze is easing. MBDA's capacity milestones under its €5 billion plan, and any move by the EU toward rare earth sourcing mandates in defence procurement, which is the policy fix Merrick's themselves flag as the thing that would actually de-risk ventures like CareMag. None of these on their own is a trade trigger. What a watch list does is let the picture update itself in front of us. So when a genuine change in the facts arrives, we notice it quickly rather than 3 weeks late. And there's some other notes I've got that go into more details that I'll attach in PDF if anyone's interested.